Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm your guest, Moises Correa. With me, as always, is your host, Tom and Mark.
For the accounting background, I think that's as good as we're getting.
Yeah, for sure.
All right. What are you up to?
A lot. I mean, we're things are really flowing here at GC. We're grinding a bunch of new changes, got a bunch of new people coming in, and then at the same time, on the investment side, I got a single family home sale-leaseback that we're buying in Schaumburg, and then looking at an industrial building that we found actually on market coincidentally out in Huntley. So fully leased. So it's not even an add value. So I actually have to put a real down payment down if I buy it. So
Oh, that's worse. No.
yeah. But the true play is I think we can raise the rents. So I think the rents are probably about 25%. So, if I have that money in there for 5 years that will refinance, then I should be able to do good at that point.
When you're looking at an industrial building, is like the rent arbitrage similar to what we would see here? Like are things like 20%, or is it higher? Is it like, oh my God, this is 50% below market?
No,
is there more variance in the rents versus the market?
No, it's usually 20-25%.
Okay.
It's usually your gap. Industrial rents have really gone up a lot in the last 5 years, just because there's just such low vacancy right now. Like when I first got into real estate, like Elk Grove, for instance, one of the largest industrial parks in the country, was like at 83% occupied. And like right now they're like over 90, like 7%. Like so, and they keep tearing down these smaller buildings where you get the smaller rents. They're just building these big buildings that you see, and those are much higher rents. And obviously your little sign guy doesn't go into 30,000 square feet with 40-foot clear. So these smaller spaces are more harder and harder to come across. And these older buildings, what I like about these is the reproduction. So the building we buy will probably buy somewhere between 80 and 85 a square foot. You can't build that building for less than 180 these days. These smaller footprints with sprinklers and the setbacks and all that stuff. So that's kind of our play of like the rebuild costs.
Nice. Well, good nuggets there.
Yeah. No, it's something I'm excited about. It's funny. It's always easy to, and this might work for anyone that's got a 9 to 5, or it's really easy to get really busy in that. I own the company with property management, but it's still really easy to get busy and not do the investing side. And I just been making more of an intentional effort to look at deals and talk to people and network more and so forth. So it's starting to pay off.
It's a simple game, man. Put in the reps.
Yep.
So, all right. What do we got for a housing provider tip of the week?
All right. So our housing provider tip of the week is for your lease. I'm watching a lot of people get creative with their leases, and then they go, I had my attorney make this lease, and they're getting in trouble because they're not following the RLTO or the CLRTO. And they might have things that totally violate. I watched somebody get in trouble for that lease a couple weeks ago just because they didn't have the simple stuff on the cover page that they had to. And the attorney they used was somebody from like Kane County, where they're not even aware of all the things that are going on in Chicago. And I don't even think they're a real estate attorney. So there's multiple different problems there. And then I see also people with leases, they might use the realtor lease for whether it be Chicago or the suburbs or Cook County. But then they add an addendum, and in the addendum, it contradicts what's in the actual lease, or it contradicts something that goes against one of these ordinances. So take a look. We're coming up to the end of the year here. Take a look at your lease and going to the new year. And it's not bad to use one of the realtor leases as your base lease and then add an addendum. Just be careful and make sure you do have an attorney review it. And make sure it's an attorney that is savvy around if you're in Cook County, the ordinance there. If you're in Chicago, the ordinance there. Just make sure that you're on top of all that. So
Good stuff. All right. Our guest today, young guy who's accomplished a lot, gone from house hacking in Avondale to owning a couple hundred units as a GP. We're going to talk about networking. We're going to talk about scaling. So a lot of great stuff here. And the founder and owner of Proximal Equity Group. Without further ado, Moises, welcome to the Underground.
Thank you, guys. Happy to be here.
Yeah, we're excited to have you. I know we were talking offline. You've had a nice little journey here, and I know we've connected a few times at meetups. So good to get you in person here. Shout out to Eric Swanson for making the introduction. I know he's your business partner. We'll bring him up for our listeners who are interested. We had him on episode 369, and let's jump in. So we'll start off. I know you're a U of I grad, so you're already doing well in my books here. Coming out of college, was real estate, was it on your mind at all?
Not really, to be honest. I started my career, studied accounting in undergrad, and started my career doing consulting, primarily M&A work for big companies downtown Chicago.
Okay, so you're doing M&A work. Where real estate hits your head at some point, though, what happens?
Yeah, so was working at my company for a while, and then transitioned over to another company, and kind of along that time frame, started thinking more about bigger picture, what I want lifestyle to look like, et cetera. And passive income is something that a lot of people think about. And that was really my first goal. So real estate naturally was one of the first places that my head went when I think passive income, and really the easiest or the most straightforward way to kind of proceed from there was a house hack. So that's where I kind of focused in, and that ended up being my first deal back in 2020 in the COVID days.
Awesome. All right. So when you get this bug though, like what, walk us through, because everyone's had their own little path. Are you just Googling real estate stuff? Are you finding bigger pockets? Is there a book or two? Like what jumping off point of like, ooh, I'm going to start exploring.
What fueled it?
Yeah. So no joke. I walked into a Barnes and Noble, went to the real estate section, and I picked up a book, and it happened to be the book on real estate investing by Brandon Turner. They had that one in physical copy, which I kind of prefer that. Picked it up, read it, enjoyed it, and then started looking at deals on the MLS.
Nice. So you start looking, where are you looking?
Well, I was looking all over. Really, it was going to be a place that I wanted to live. So it was pretty much like the outskirts of the north side. So I was looking like, and I guess some west side neighborhoods as well. I was looking Rogers Park, Albany Park, Avondale, looked in Humboldt Park. I looked in some like Tri-Taylor area as well. I'd say those were kind of the main ones.
All right. And then how old are you at this point?
31.
You have some money behind you, right? You're not 22, just fresh out of college. You've had a nice career. You have money to do this house hack. Were there any that, you put under contract that didn't fall through, or the first one you put under ends up being the guy?
The first one that I put under contract was the one that I closed on, but I was looking for at least 6 months before I actually put anything under contract.
Okay. And like serious looking, like going out there to walking properties?
Yeah, I was biking to properties every weekend, doing showings. I didn't have a car back then, so did that for several months.
Bought the house before the car?
I bought the house before the car, yeah. I used to live downtown, so I didn't need a car.
All right. And then where, big reveal here, where's the first one?
Avondale.
All right. You still own it today?
Yes, I still live there.
Nice. All right. And this is in 2020, so you have a 3% mortgage or something awesome, I assume.
Yeah, I had, so I did an ARM. It was I pretty much levered up as much as I could. So it was a 2-unit deal with in-law. Basically, I moved into the in-law unit, renovated the rest of the property. Then I moved into the top floor and rented out the in-law. I actually did Airbnb for a bit, which is a whole nother story as well. I did a refi, cash out refi, which went awesome. And that was really a big piece of what ended up bringing me towards quitting my job and pursuing real estate full time. So blessed to have that.
When you say in-law, are you saying there's like a garden?
Yeah.
So a
in-law
non-conforming
garden.
third?
Yeah.
All right.
Exactly. Yep.
A couple of things there. What made you want to do the Airbnb? Let's talk through some. I'm assuming you messed some things up there, so let's talk about it.
Yeah, I mean, the mess ups came before the Airbnb. It was with a tenant, had like a nightmare tenant situation.
Did you know that walking in or no?
No, it was a tenant that I vetted, and it was my own doing. There were red flags that, I mean, looking back, I don't know that I would have done anything differently. I think I made the best decision that I could have with the information I had at that time, but this lady ended up being, I mean, I don't need to get into all of it, but she was like lying about stuff and she ended up moving out. So I didn't have to do an eviction or anything, but she left the unit in a mess, and the unit wasn't insulated too. So when she left, instead of getting it insulated and doing a bunch of work, I was like, okay, well, if I do Airbnb, no one's coming to Chicago when it's cold anyways. It's not a big deal. So I furnished it all, did the whole Airbnb thing. That ended up going really well for a while. Ended up just being like too much stuff going on with, it's a very active business, for sure. I was able to like make it as passive as I thought I could, but ended up switching it back to long term. I insulated it, did all the work to kind of bring it up to where it needed to be, and it's rented now.
What was the issue you ran into with installation? That lady was complaining it was too cold, and like.
Yeah, that was part of it. But I mean, there were other issues. She was like a single mom, and she was just like making up stories about stuff, and her rent started being late, and I would ask her questions about it, and she would tell me stuff that I knew was just not true. I mean, it was some deep stuff. Like she lied about her brother committing suicide, and it's like, okay, well, I can't really like press too much. I also have to be like a person, and it's kind of hard to navigate that because you have to be delicate, and
It's hard to say, show me the death certificate.
yeah, exactly. So it was just kind of a pain. So went from that to Airbnb, ended up deciding to take that off, and went back to long-term, and I have a great tenant in there now, and much better situation.
I'm curious, leaning on the insulation issue you ran into, because I hear about these things all the time. 120-year-old buildings, none of them are really airtight. Like, what was it? Was it the old plaster and it was just thin still? Or
No, so the old owner built that out, built out the
an
unit.
addition. Okay.
Yeah, so it was like a empty basement at some point, and then they, it was like the foundation wall, they framed it, and then they put drywall over it, but they didn't put insulation within the framing. So basically what I did was I had someone come out, they cut like a strip of drywall across the perimeter of the exterior, and then just spray foamed up, spray foamed down, and sealed it back up. So that fixed the issue, and yeah.
How do you do your basements as far as insulation? You guys do you guys put the plastic up with that?
No, we just spray.
Spray it?
Yeah.
Okay.
What going back to Airbnb, what were you getting? What did you end up getting in rents compared to long term, either percentage wise or real number wise?
It was pretty similar. It ended up being, I was renting it for I think around $1,800 before I put it on Airbnb, and then on average I was making around $2,000 a month through Airbnb.
All right, so now we're
Annualized. Yeah, so it wasn't like a whole lot more.
well now, and you're paying utilities, and you're providing internet, and just the amount of effort to get that money, like it needs to be a bigger return.
Yeah, for sure. And it's a 2-bed, 1-bath, so it's perfectly fine to have long-term tenants there. So yeah, it's I think it's better how it ended up, and all the better for it from the learning. I guess I'll take that with gratitude and move on.
And anything from there, like going through that experience, like if you were to Airbnb again, where you'd be like, oh crap, like I definitely messed that up. Whether it be on the marketing side, the operation side.
Outsourcing versus handling yourself even?
I handled everything myself. I didn't really look too much into outsourcing. I lived in the building, so it's like makes it easier. I wasn't doing the cleaning. I had a person kind of do the cleaning for me. That was fine. I would say just like being very clear on communication. I think I did a good job with this, put together like a guide with any question that I could possibly think of. One reason that, I guess digging into it a little bit, one thing that did come up was in the listing, I had street parking, and then I had, when you go through Airbnb and you set up your listing, you click the boxes of all the different amenities that your listing offers. One of them was on-site parking, one was street parking. When I set it up, I didn't know the difference. I clicked both of them. Turns out I don't have on-site parking because that means that you have like a driveway or a garage or something like that. It's just street parking. I do have street parking available like right in front of my house, but that's technically not on-site parking. Tenant got a ticket because they parked in front of a fire hydrant, which is like a whole nother issue. You can't really do that anywhere. But then they asked me to reimburse it. I said no. They complained to Airbnb, and that was a whole fiasco with Airbnb because I was like, this isn't fair. And they said, well, your listing is actually incorrect. And I was like, you're right. That's just an honest mistake. And I mean, I lost that one, but it is what it is.
All right, so we have some success here, right? Like, what is the next move, right? You're like, I'm gonna go buy another 2-unit, 3-unit. Like, where do we go from here?
Yeah, so from there, I ended up buying a very similar deal also in Avondale with my fiancée. Another 2-unit building with a non-conforming attic this time.
What's our time frame? Your first one was 2020. This one is
2022.
okay. So you're stabilized, you cash out, and then you go after the second one?
Yep. Then we did the second one. That one actually was right after I left my job. So in between there, in between the first one and the second one, I left my job to pursue full time.
So hold on, let's talk through that. 'Cause
Yeah.
that's pretty ballsy, man. You got one unit under your belt.
Yeah.
It's not like
Yep. Yeah. So I mean, it was a big decision for me. I guess for background, I used to work at an investment firm, investing in lower middle market healthcare deals. So lower middle market, when you're talking about businesses, is, anyways, the way we defined it was between $5 and $20 million of EBITDA or profit. So that was the asset class that I was focused on. So think like dental platforms, vet clinics, dermatology, specialty pharma, et cetera. I'd say probably 70-80% of the stuff I was working on was healthcare related. And it was very intensive finance and legal type stuff in terms of just like looking at these deals, trying to understand kind of
this sounds awful.
the pros and cons of them. Yeah, I mean, it was actually very interesting. It was just a ton of...
I don't have the attention to detail to. I can't even finish this conversation without interrupting you. Like, I can't focus.
Well, those businesses went through a extreme like roll up period. Was that a lot of what you're working on? Those businesses getting rolled up?
Exactly. So it was a lot of that. And then that was, I mean, through COVID too, it was crazy because you couldn't go to the dentist when you were in COVID, right? So there was a bunch of fire drills related to cash flow issues with those businesses. We're basically working on best way to keep those above water and make sure that investments preserved and all that kind of stuff. So definitely an amazing learning experience. And I did enjoy the job. It was just, frankly, I didn't really feel like I had enough time to do the real estate stuff that I really wanted to do, especially after the first deal. Definitely was very challenging and learned a lot. I shared a little bit about the nightmare tenant and kind of all that stuff, but I did like it. I found it to be fulfilling, and the deal now is very successful. Like looking back at it, bought it, cash out refi, it's cash flowing really well. I live there, all the kind of stuff that you would ideally want to see from a first deal, if you ask me, So that was part of it. Because now I'm not even remembering your original question, Tom.
How do you just walking away from that W-2 though, right? You don't have a ton of money lined up. You have the cash out refi, which is great, but like, you're not living off cash flow of one deal, especially when you're taking up one of the units. Like, what gave you the courage to say like, I'm going to do this? And what was in your head like, this is how I'm going to get money to pay bills?
I guess I did have a decent amount of money saved up. I had good jobs and I was making good money, so
You didn't have a car,
helped.
so you're
yeah. I had gotten a car by that point.
$30 grand right there over a few years.
I had gotten a car by that point. When I moved to Avondale, thought it would be easier to. I didn't have a car for like the first maybe 6 months, and then I ended up giving in because it was hard to get groceries in the cold. To answer your question, the property was basically paying for itself. I was living for free, making a little bit of money. And I live with my fiancée too, and she still has a job. So, and I had money saved up. So between all those things, I was like, well, let's give this a shot. I was also actually looking for other jobs too before I had left. Because really my goal was to try to find something where I could keep W-2 income coming in, but I had more time because I was just kind of working crazy hours and very stressed out all the time and all that. For a while, even after I quit, I was thinking about other jobs, looked for a little bit, but as I looked at more and more deals, I was like, well, this is going to take up a lot of time if I want to seriously commit to it. So it was definitely scary, very scary. It was almost 2 years to the day that I closed the first bigger deal after leaving my job. So it was very stressful. I probably wouldn't recommend it to people, to be honest, and ended up, I mean, knock on wood, it's working out well so far.
For you personally, I get like, not recommending to others because of the risk, but for you personally, knowing what you know now, would you still go through it with it, or would you have waited a little longer?
I mean, knowing if I would have known kind of where I ended up, then yeah, it's definitely worth it. What I'm working on now is exciting to me, and I'm building a business too. So it's more than just kind of the actual real estate assets that we're buying. Basically, I was getting to the point where if I would have waited longer, I would have started to make even more money at my job, and then it gets harder and harder to step away from it. And then the job too, it's like very bonus heavy, right? So you get your salary and you have your bonus. You get your bonus once per year. So if you were to leave your job halfway through the year, before you get your bonus, you're basically getting underpaid for 6 months. So it was like cash out refi bonus. Am I going to do this another year? Yes or no? I just voted no and went from there.
I used to love that. And then same thing. The bonus would come out in like March for the, it'd be year end. They'd take time to calculate. It would come out in February, March. And then the company would be shocked that like 10% of the workforce quit. It's like, what do you think? It's very obvious that this is the day that everyone's going to quit that has been waiting to quit for the last 6 months. Like
We're shifting some of our compensation towards like monthly bonus versus annual bonus. And that was like one of the things like, well, then what's going to keep people here to the till March every year? We actually went back and we looked, and like no one ever quit in the month of March or April. So like, your first thought
your
is
bonuses aren't as high then.
Yeah. Your first thought is like everyone's just gonna leave. Like that was why we're like, maybe we shouldn't do this monthly. Like we got nervous.
So all right, so then you buy the second one in Avondale. At this point, you're without W-2 income.
Like I said, I was living with my fiancée, so that one, she was the one that basically was like the guarantor on the loan for that. But we did it together, and took a bunch of the learnings from the first one, applied it. I was a GC on the project. And that one ended up going really well too. It's stabilized now.
How much work? You said GC, like how much work did you have to put into it?
It was a good amount. We ended up at like 130K maybe.
Okay. That's a serious rehab.
Yep. All right. And then now, is this the next one going to be one of the big deals, or do you have some more, these 2 units hanging around Avondale?
No, the next one was a big one.
Let's talk about this, because there's a lot of people who do exactly what you've done. They bought their first, they bought their second, you kind of house hacking. They're like, man, I want to scale up. I want to do something bigger. And you're one of the examples that has done this. So talk to us a little about, was it a mindset shift, just circumstance? Like, how did this happen?
Good question. So, I was looking, my original plan when I left my job was to scale up in Chicago, buy properties little by little and build a portfolio. Was struggling with that. They were just like very difficult to find deals that I felt were worth pursuing and raising equity for. At the end of the day, trying to prioritize my investors as much as possible. And what I was finding was, well, if I'm prioritizing my investors, then like I'm not really going to make money with how these deals are looking on paper. If I'm underwriting them conservatively, I can't reasonably project to give them good returns and also make money for myself. It's not going to be worth it.
Yep. And when you say investors, who are we talking about here?
I mean, it can be anyone and everyone and anyone. It was former colleagues, friends, people that I had met at networking events. For the first year or two after I had left my W-2, I was doing a ton of just networking and outreach. I met really amazing partners through just like emails to people, send out 100 emails, hope to get a couple back, type of thing.
Now, what are those emails like saying? Like, you're not saying, hey, I'm interested in a deal, you want to be a partner? Or is it more just like what you're working on? Like,
just asking if they want to get coffee.
Gotcha.
Yeah.
So you went right from the really grassroots, like get to know you, learn what you're about, learn what I'm about, and then maybe I could turn it into something bigger.
Yeah, I mean, you're not going to click with every single person that you meet. You can usually tell relatively quickly if there's something potentially there, So, and not everyone has to be a partner, right? Like, it's good to just kind of meet people, see what people are up to, share what you're doing, and there could be opportunities to collaborate. Maybe not. Either way, that's okay. I think when you're talking to people, it's just a matter of being real and sharing, like I said, what you're doing and what you're trying to accomplish. And what I found is like people are generally excited and happy for other people doing things that they want to be doing and taking risks and pursuing cool things, right? You guys have had really cool people on this podcast, and I'm sure a lot of them would say just like networking is a big part of it. Even if you don't call it networking, right? It's just meeting people and being friendly and whatever, you know?
I love that because, and you're probably not even getting the dividends from it yet, but there's such long-term gains from that. So the 200 hours you might have put into networking, there's a good chance they'll pay off 2 decades from now. Like I'm finally at the stage where it's like, I'm actually doing stuff or talking to people or working together with people that I met 2 decades ago, 20 years ago. And that's such a huge play to the long game that people, you know, we're in this instant gratification world where it's like, that's huge what you did. And a lot of, that's anyone listening, like that's such a huge way to build your network fast.
Yeah. All right. So is this where you meet Swanson then? Like what happens here?
We did the first deal before I had met Eric. I had met one of my partners, Adam, through, it was actually just like a email that I had sent, and we ended up getting lunch and realized we were looking at deals in similar markets. He had a deal under his belt as well, he had one syndication under his belt, I should say. He had done a lot of deals before then.
And so what if he's got something done and you don't? What are you bringing to the table?
My expertise is really more so on the numbers front. So with these bigger deals, it's different than a 2-flat or a 4-flat type of thing because you're looking at it more as like I think of it as a mini business, right? You have your revenue, you have your expenses, you have your NOI. If you're looking big picture, you have to increase NOI, and usually that's a combination of both revenue and expenses. But the way that you underwrite it is more so like a business. You're not worried about every single unit and every single lease. It's bigger picture. You're using bigger numbers of this percentage vacancy, this percentage bad debt. You look at historical performance, whereas like the deals that I was doing in Chicago, I didn't really care about historical performance. I know what I'm buying. I know if it's vacant, I'm going to have 6 months or 12 months, whatever it is, of like no money coming in. Do I have enough money to pay for it? Yes. Do I think I can get good rents once I'm done with it? Yes. Do I think I could do it for this amount of money? Yes. And it's like much more straightforward.
Your brain works as like a decision tree. Just the way you talk about things, it's, you come to a point, decision, yes, no, then you like, I can totally picture like these charts in your head of how you make decisions.
And I'm oversimplifying it. I don't want to make it seem like
But that's what works though. So sometimes people get hung up in not having it as simple as you're kind of wording it.
That was really what I was bringing to the table. I had a lot of experience underwriting big deals. Like we were working on deals that were $50 to $500 million. I was used to larger transactions, and the way those go about is very similar in terms of underwriting them, putting in an offer, letter of intent is what we'd call them. Then even getting to a contract is a whole another step. It's very different from like a 2-flat where you have a more or less standard contract with some things that change. With a larger deal, there's 100 different things that get negotiated in or out. So it's much more involved, and I felt very confident doing that. Just getting to closing. I mean, honestly, quarterbacking one of these deals is a ton of work, and there's a ton that goes into it. So, and you can be under contract for a long time, 2, 3, 4. The first deal we were under contract for 5 months because we had a government subsidy contract that we actually had to assume from the buyer. So I'm actually a federal government contractor now. We get some money from the federal government. I had to get a cage code and log in with sam.gov and all that. And that whole process was something that I had to learn from scratch too. It was literally just reading these guides online from the 90s that had never been updated and calling these government workers that didn't want to share anything because they leave at 3 p.m. or whatever and just refer you to other people. And it was a bunch of phone calls and a lot of scrappiness to get that one done for sure. But we got it done, thankfully. And we're just wrapping up the stabilization. Very pleased with how it's coming together.
Going from a consultant or broker on a big deal, big numbers, to quarterbacking one that you're the investor and your reputation's on the line. What was the differences there for you? Was it same thing? Like, was there different concerns? Like, because there is a transition there, because there's a lot more on the line when it's you.
Yeah, absolutely. Definitely a lot more on the line, a much greater sense of responsibility. I feel very blessed to have people that trust me. I think me having the confidence in the deal itself and the conviction to make it successful is important. It's critical, really. So I think that's where it starts, right? Like really feeling very, very solid about the deal, knowing that you have the right team to make it successful is a huge piece of it. The first deal that we found, like I said, it took a long time to find it. We ended up buying it really well. We bought it for $55,000 per unit, to give you an idea.
Where? Location?
That one was in Louisville, Kentucky.
You guys meet. Let's take it one step back here. You guys meet. You're talking about different markets. You're kind of both looking the same. Cool. You're looking at something in Louisville. Like that's probably foreign to a lot of our listeners. Just talk to us about how you're making connections down there, how you're doing your due diligence down there. Like we're kind of glossing over that, which I think is a very big step.
My partner Adam, who I mentioned, was born and raised there, and then our other partner Jeff, he is a GC. He's a 25 plus year GC. That has worked with real estate investors for most of his career. I mean, that was a big piece of it, looking at all the rent comps in very great detail, and the sale comps too. Honestly, that's a huge piece of it. We were buying it, like I said, $55K a door. We were looking at comps that were in that year, 80, 90K per unit. So we knew right off the bat, like, we're in the money kind of thing. And the property was full. The rents were low, but the property was fully occupied. So you know there's demand. You know you're buying it well. You know that you have a GC that's confident in doing the work. We had a strong connection too with a property manager that we had worked with before, who was excited about the project. All those things together made it, I don't want to say it was easy, but we were very excited about the deal when we found it, when we were getting it under contract. It's funny, I had actually looked at that deal almost a year before we put it under contract. I had bid, it was like $500K more at that time. Rates were lower, and I lost the bid. Someone bid even more than I did. It fell out of contract. Went under contract with a different buyer. It sounds like they had misbudgeted insurance. So as I said, budgeting conservatively is key. And then went under contract with a different buyer, fell out again. That was right when rates were going up too. So it was like, it's all timing, really. It's a huge piece of it. And we had already looked at it, got in touch with the broker, like the week after it had fallen out of contract the second time. The sellers had another project that they were doing, and they wanted to basically take their capital and move it to another project. So they reluctantly agreed to our price, and we got it under contract and then started everything from there. It was a long process for sure. But yeah, got it under contract December of 2024 and closed it in got under contract December of 2023 and closed it in in May 2024.
And how much money did you have to raise for this?
We raised $4.1 million.
A lot of money, right? Like where is that coming from?
Oh, let me ask this question. You raised 4.1, but how much did you have to go out there and try getting commitments on? Because half of them usually back out. Did you try to over raise?
We didn't try to over raise. I think we got other general partners at co-GPs that helped to raise money with us too. Again, going back to the network, right? Like this was someone that I had started conversations with like a year before or something, and had just kind of kept in touch. And it was kind of right place, right time for them as well, where they had been looking for a while, and it had been a while since they had gotten a deal. And then we approached him, hey, we've got this one. Do you want to partner on it? And he said yes. So that definitely helped, and honestly gave me a lot of, not that I didn't have conviction before, but got a career in doing this, and he was very excited about the deal too. So he helped raise money as well. we got to the 4.1, we closed it, and then started doing renovations right away. So we got, it's like about a 30% rent premium on average. So, I mean, if you think buying it at $55 a door, renting them on average $1,000, $1,100 a unit, like the ratio there is really strong relative to, I mean, in Chicago, everything's very, very expensive, and rents are definitely higher, but they're not 4 or 5 times higher.
When you're going through this, like it's great that you have this network. You're bringing in people. You don't have to share all this, but talk about structure, right? Like, it's yes, it's a profitable deal. Yes, it's a great deal, but investors gotta get paid. You gotta get paid. GC's gotta get paid. Someone's doing the asset management over the property manager. Can you share a little bit about just like how you guys structure this so everyone's happy?
Yeah, good question. So I guess starting from the beginning, right? Like the deal is owned by a legal entity. So that legal entity owns title to the property. And I guess I should start by saying like there's a million different ways you could do this. And even with the deals that I've done, each deal has been a little bit different. But for that one, and I guess I would say in general, you have a legal entity that owns the property. Sometimes you have another legal entity that owns that one, and that's the one that investors basically buy into. So you have, generally speaking, classes of shares. So you have limited partners and you have general partners. General partners are the ones that are originating and executing the project, and limited partners are the ones that are contributing capital. I was both a general partner and a limited partner, so I invested my money, and I was a general partner for doing the business plan. In all of our deals, we're prioritizing the LPs. Generally speaking, LPs have first right to cash flow, profits, et cetera, and then after we meet certain thresholds, whether that's investors need to get made whole or certain return thresholds or what have you, then that's when general partners start participating in the upside. So basically what that does is incentivizes GPs. It's performance-based compensation, right? So similar to what I was doing before, where your bonus goes up and down depending on how you do, very similar thing where if you do good deals, you make more money. If you do bad deals, you don't make money. Because you're talking about a lot of money on the line, and got to make sure that people fronting the money are getting the protections that they need and the returns that they need. Because I'm looking at this as a long-term thing. Want to be working with people that are long-term minded and will be excited about the returns that we're providing, the deals that we're doing, what we're building as a company, going from there basically. So does that answer your question in terms of the...
Yep. And then I guess amongst the GPs though, right? Like how, yes, that's a good answer. But then like even internally, as you keep bringing on people, like it gets diluted. Yep. Right. Yeah. So just talk about how you keep everyone happy there. And maybe better way to ask the question is just roles and responsibility.
Basically like the general partnership, and that can range too, depending on the deal. Say it's 30% of the deal, right? That 30% would get split up into different categories, and that's going to what you had said about roles and responsibilities. So X amount gets split into the acquisition upfront work, X amount gets split into the asset management work, X amount gets split into capital raising, for example. And these categories are not fixed by any means. We've had different categories depending on the different deal. For these bigger deals too, you need a guarantor, basically. So for those of you that don't know what it is, basically like a high net worth person that has a high net worth, but then also liquidity that the lender needs in order to get them comfortable and actually give you the loan. So depending on the deal, we carved out percentage for that person. So like a high net worth person that is saying, yes, I like this deal, I will sign on the loan with you guys, and basically like put my balance sheet on the line for the lender to help you guys get the loan, basically. And then we all kind of know, okay, these are different categories, let's go do the deal and make it successful.
So then how are you getting paid, right? Like you're on the GP, but I'm assuming there's some sort of like acquisition fee. We don't have to get into pure numbers, but just I'm thinking from the terms of someone who's listening to this saying like, great, I would love to quit my job and do this too. But like, how is income actually coming in while you wait to stabilize the building?
Yeah, so there's an acquisition fee that's paid upfront or at closing, I should say, and that's basically for all the work leading up to the acquisition and the risk, honestly, because these bigger deals, they can take a lot of money just to get them to the closing table. You're talking about six-figure earnest money deposits at some point. You have deposits for the lender. You're talking about very expensive legal bills, et cetera, right? So that's the acquisition fee. And then there's an asset management fee that basically just helps. It doesn't end up being a whole lot of money, honestly. It's 2% of revenue is usually what we do. So that helps us pay for the softwares that we use to basically manage the investor setup, cover expenses as it relates to going down to the property, things like that. But really the bulk of the compensation for us as GPs comes when you exit. So whether that's a refinance or a sale, that's when you can really make a good chunk of money because you are adding a ton of value to these deals. So commercial real estate is valued based off of the NOI that it makes, right? So say theoretically you had two buildings and somehow they could be in the exact same place, same construction, same everything, but one made $5 a year, one made $10 a year. The one that made $10 a year would be twice as much. So if you can double the NOI in a big building, you essentially double the value of the building. So it's not that clean and there's other things that go into it, but generally speaking, that's how it works. So if you can do that and then do a refi or do a sale and have a capital event for your investors, that's really when you can start seeing the benefits as a GP. So it's definitely a longer term game, multi-year projects. That's how it works.
What do most investors like as far as cashing out or selling? What's usually what they tell investors in a deal like this? Is it 2 years? Is it 5 years? What's kind of the range, I guess?
We've done deals that are 5-year holds, and then we've done deals that are like more longer term, so call them like indefinite holds. So deals that we are excited about holding for longer term. Usually those ones have some sort of refinance component. So similar to what I did with the first deal I mentioned in Avondale, where you increase the value and you do a cash out, same type of thing on a bigger scale. But then you can return capital to investors and keep owning it. And if you start talking about taxes, I mean, it becomes even more exciting because the proceeds from the cash out refinance are not taxed because it's not income. That's really when you can start seeing like all this stuff compound.
And the faster you get that money back, the faster you as a GP or the group of GPs start making more money. So, right?
Yeah, exactly. So once investors have their capital back, then generally speaking, GPs start to participate in the cash flow and stuff. So the faster that you can do that, the better. Deals are all different though. So like some of them, you have an opportunity to drive value very quickly. Some of them, it's going to take time. And what matters is just kind of communicating clearly to investors what your business plan is, so everyone's aware of what they're getting into and making sure it aligns with their goals overall.
Working through this Louisville one, is the Fort Wayne one the next one then?
No, we did 2 others in Louisville.
Oh man, you're killing it down there.
Yeah.
Those other ones that you did down there, any we don't have to go through each deal in as much detail as we just did, but anything you would take away from those? Any funny stories, any horror stories, anything worth sharing that you think our listeners would want to hear?
So the first one was 160 units. The second one was 40 units, and it was adjacent. So the parcels actually met. There's a small easement in between, but we're managing that as a 200-unit deal now out of the same office. So that's worth noting. I think generally speaking, right, you want to sell like a bigger asset. You can usually get a better bang for your buck. So if you're selling 100 units versus 200 units, you're going to get more money on a price per unit basis for more units. Not always, but generally. So I'd say that's worth noting because now we have 200 units right next to each other, which we're excited about.
So you folded the 40 into the first deal, or you didn't go do a second raise?
Yeah, we did. It was a whole new deal, separate deal.
Okay.
Yeah, separate deal altogether. We're just managing it as one, basically.
But the two can ultimately help each side. 1 + 1 = 3 in this situation.
That's exactly right. We're not like merging the companies or.
But it's mutually beneficial. I gotcha.
Anything, looking back on this, you've done 3 big deals in Louisville. Looking back on it, what would be the one thing you would change? It sounds like things have gone smooth, but there's got to be some hiccups here that you've learned from.
It's been a lot of learnings for sure. We had a fire at one of the units. Thankfully, no one was hurt, but it was a tenant's kid was playing with a lighter. So took out 2 units, and we had to go through a whole kind of insurance process thing. So that was a learning. We had a bunch of physical stuff come up on the first deal we did with like main waste lines getting busted and that kind of thing. So I don't know that there's anything that we could have changed necessarily, but I mean, I would say if anything, having more money on hand is better. Thankfully, the insurance company that we had was good to us, and we got the money back and then some, but that's not always going to be the case. Noting that.
And then what about just you as an underwriter, right? You're the guy looking at all these, and this could be good or bad. Like, have you changed how you look at these deals? Are you getting more aggressive with rent growth because you've seen it in person now, or more aggressive with your vacancy numbers? Like now that you've lived through it, like I'm assuming your underwriting has changed one way or the other.
Yeah, I mean, if anything, it's gotten more conservative, mainly with like the budgeting stuff, having more cash on hand to pay for things that come up. For the second and the third deal, definitely just like over budgeted. And the first deal too, we bought it so well that it ended up being fine, you know, but as you get into bigger deals, it becomes harder to win them because you're competing against stronger buyers. It becomes more and more important. If you're like too conservative, then you're not going to buy anything because your pricing is going to be way off, which maybe is okay, right? Like no deal is better than a bad deal. But there is definitely a balance there of like knowing where you can be more aggressive versus not. It helps definitely to have already assets in the area because you can know with a lot more certainty, like, yeah, I know I can get this because I'm getting this next door type of thing.
Big companies, small companies, you're talking about bidding on the same property. What advantages does the smaller guy have over the bigger guy in your eyes?
I mean, I'd say the advantages for the smaller guy come on like the smaller deals. So in the real estate world, you think of like what we call institutional buyers. So these are very large companies that have millions, sometimes billions of dollars under management. And for the bigger ones, when you're talking about maybe over $30 million, that's kind of where they play. But if you're looking at deals that are $10 or $15 million, those guys won't necessarily come down to that low of pricing. That's where you can kind of get deals if you are in the right place, right time type of thing. With the bigger assets, like when you're talking about the size that I had mentioned, it's very, very difficult to win deals, and you need a lot of financial backing, honestly, too.
Will an institutional buyer be willing to pay more because they have to keep that money working versus maybe your more conservative numbers?
That's a good point. Depending on how they're set up, I mean, some of these buyers have different mandates or have different fund structures or whatever. So if it's a fund that already collected the capital or already has capital committed and they have 3 years to deploy $100 million, then they're going to be more aggressive. Versus us, we're raising capital on a deal by deal basis. So we can be more patient and look at deals that are the exact deals that we want to do.
Let's talk about this Fort Wayne one, because Swanson shared this with me. This is a great deal. You guys got a lot of upside there. Just give us the oral history. How did this one come to fruition, and how did it all get put together?
This deal it's 168 units in Fort Wayne, Indiana. I've been working with the broker that brought us the deal for a few years now. So regional broker, they do deals in Indiana, Ohio, Kentucky, Tennessee, a few other states as well. I was actually giving him feedback on a deal that I was looking at in Cincinnati, Ohio. I wasn't close on that one and just kind of said so, which is another thing too of just like getting the reps in with these brokers. Even if you don't think that it's going to be a deal for you, it's still helpful for them to know where you might shake out on price.
Hold on, that's a huge point. Let's dive in here. So a couple of things. Like one, sometimes it does come back around. Sometimes you do get it. Like two, sometimes they take that to the seller. If they're hearing it from you and 3 other guys, like you can move the needle there. Because everyone's underwriting it the same way. Right. And then probably most importantly, it's just showing that you give a damn. Like if you only call the guy back when you like the deal, like it's a pretty shitty way to treat the broker.
Yeah.
Right. Like just
for sure.
giving the honest feedback of like, hey, this one, I'm not, and I usually blame myself. I say, I'm not the buyer here. This is where I'm at. Like it fits someone else's buy box. But for me, this is how I'm going to go about it. So I need to be at this price.
That's the best way to frame it.
Yeah. Like
Like,
it's on you. It's not, oh my God, dude, this is overpriced. Like,
Yeah.
Miles was talking about that when we had him here. We recorded and like, oh, you're crazy. It's like, well, someone's going to buy this at this price and we'll probably have multiple bids. It's like, I'm not crazy. Yeah. Like buy boxes are contextual. They're individualized.
Yeah, that's exactly what I was doing. So I was giving him feedback on another deal and just asked him, hey, you have anything else that's coming up? He said, yeah, I have one that we're bringing to market in a few weeks. I'll keep you posted. I said, just tell me about it. He's like, oh, it's in Fort Wayne. I was like, okay. He's like, yeah, this is what they want per unit. It's coming out of it just got out of its LIHTC period. So LIHTC stands for Low Income Housing Tax Credits. It's a affordability program. It's a federal program that's administered by each state individually. And I had spent a couple years digging into that. It's a whole fascinating niche within the real estate industry. So I knew kind of how that worked, and I knew right away that there was a lot of opportunity there because of how that program works and how the restrictions work. So I said, okay, like, can I see it before you put it on the market or whatever? He's like, actually, I'm talking to the owner tomorrow. This was a Thursday, maybe 3 or 4 p.m. He's like, if you give me an LOI by 1, I'll show it to him. So underwrote it that night, had a call with my team the next morning, got him the LOI, went back and forth for a couple weeks on terms, and ultimately got it signed up before he took it to market. That was huge. We were the only group that got to see the deal, which is awesome because I'm sure if this would have gone to market, it would have gotten bidded up and sold for much more than what we're buying it for. So that's how that one came up.
What excites you about this deal? Share some details.
This deal, like I said, it's coming out of its LIHTC period. So basically it's a restriction on the property that says that you can only rent it for X amount or to people that make X amount of money. And these restrictions are very long, 15 years or 30 years. So it's not every day that these deals come out of the period, of the restriction period, and had just gotten out in February. So right now it's September 2025. It got released in February 2025. If you didn't know how this program worked, then, I mean, some people might overlook it because on the T12 basis, it's very low rents, right? T12, like the last 12 months of operations, the P&L. But I mean, I knew, well, yeah, rents are $700, but that's not market. These were also huge units. You're talking 2, 3, 4 bedroom units. There's no 1-beds on the property. And they're all in great shape. The other thing with these LIHTC deals is it's a federal program, like I mentioned. So there's very, very strict standards on how they need to be constructed. You need to have like all your T's crossed and I's dotted in terms of what contractors you use and how they're built and whatever. You need to use basically the top quality standards when you're built. So the bones of these things are usually very good. That gave me comfort around the physical condition. And like I said, I knew kind of the potential on the rents. I knew the unit mix. I knew the square footage. One of our other partners, Jeremy, is also from Fort Wayne area and owned units in the area. And when I talked to him about the deal, he's like, yeah, this is the lowest basis that I've seen in 8 years of investing here. So that was super exciting. So yeah, I mean, like I said, the NOI change from where it's at to where you can bring it is where you create the equity value. And there was a huge potential equity value here. So we got really aggressive with the terms that we presented. We ended up putting down hard earnest money, tight timeline to close.
Is this before you even walked the property?
The hard earnest money was not, but the shortened timeline.
LI and original earnest, and then once you walk it, then you go hard.
Yeah, we walked it. There were other kind of nuances with the deal too, because one of the buildings was damaged by a fire. So we were, part of the business plan is to like rebuild that. They were actually going to demo that building. Construction partner Jeff, he walked it as well, and he's like, "Hey, don't let them demo this. We can save this." So that was part of it too. So there was a lot of back and forth, but ultimately we ended up agreeing on terms. Closing's gotten pushed, but knock on wood, we'll get it done either tomorrow or early next week.
By the time this comes out,
Yeah,
by the time everyone's hearing this.
Think about this, though. The seller had such a huge opportunity on his hands, but he said, I don't want to figure out how to get all these rents up, and I don't want to figure out how to, he was just going to tear down that building because it was a pain in the butt, and he didn't want to do what he had to do to call up a guy like your contractor and turn it around. So you were getting this opportunity just because somebody else just either doesn't want to deal with it. Maybe he made his money already. So it's such a huge thing of what a play here. There's a lot of that's where everyone listening here has opportunity of someone else just gives up on it and is done with it, checks out and says, you go deal with it.
There's also something to be said, when you own real estate for a long time, you become complacent. You
Agreed.
don't have investors. Personally, I have the original townhome my wife and I bought right out of college. The lady living there has been there for 8 years, and she's well under market and fine by me, right? The thing's paid off. There's no things working great for me.
I have that tenant in West Chicago,
and she's awesome. So it's this works for everybody. Where if I sold it and someone wanted to use it as a rental, they would have an uncomfortable conversation with her, right? Because it's a different mindset and a different, everything is just, it comes down to individual and you mentioned before, timing. So. And
then part of you feels good because you're doing a favor for that person by keeping it low. That's how it is for me. It's I feel good about it.
It's one of those things where you're bad tenants don't receive low rent, right? They don't receive the benefit of the doubt. Good tenants do.
Yeah.
Right. If you're a good tenant, if you're a good person, you usually get the benefit of the doubt there. Right?
Yeah.
It's just human nature.
All right. What's been your competitive advantage? How have you been able to do this while others wish they could take this huge leap like you have?
I would honestly look to kind of the people that you surround yourself with, have amazing partners, and I've been blessed to be able to meet really cool people that are excited about what we're doing.
Your network is your net worth, right? There you go.
Yeah. Well, also you use the word blessed. You took the initiative to set up 200 coffee dates or whatever, right?
Yeah,
it's pretty simple. The math checks out here.
Maybe blessed with good genes. Maybe that's what you're blessed with.
All right. What is the one piece of advice you would tell someone that is yet to buy that first property?
I guess looking back at the first deal that I did, I remember that I was going back and forth with the seller on price. At the end of the day, I just went ahead and paid what her lowest was, and I am so happy that I did. So my piece of advice would be, obviously, take this with a grain of salt, right? But don't be afraid to overpay on your first deal, especially if it's a house hack. It matters more to get the deal and do it, and you're gonna learn and you're gonna mess up and whatever. But if you don't do it, and you're at the end of the day talking about, in my case, it was $20,000 difference. I've made way more than that. Yeah, and plus the appreciation and everything else. That's really a drop in the bucket over that deal, but also over a decade or 2 decades or whatever, So don't try to nickel and dime. If the deal works, just go ahead and do it.
Love it.
What do you do for fun?
I like to go on walks. It's my fiancée. We dog sit a lot.
You gotta do more fun stuff than walking. Come on.
Yeah. I try to, I love to travel. I love to try new foods. I like to work out.
Shower.
He's
just listing off things.
Yeah. I guess I'm pretty boring, huh?
This is truly the guy who does the answer I would expect from someone who's looking at the spreadsheets.
Yeah.
Right?
Yep.
Yeah.
No, we appreciate your answer. You don't got to keep going.
Okay. You don't have to make anything up.
We won't make you uncomfortable.
What's a good book, podcast, or self-development activity you'd recommend to our listeners?
One book, it wasn't the most recent one I read, but I read a book called What It Takes by Stephen Schwartzman, which is a good one.
Awesome. Link to that in the show notes.
Other than yourself, name a valuable resource in Chicago for other Chicago real estate investors.
Honestly, this podcast was great for me. I remember listening to it when I first left my W-2, and it was really helpful in kind of getting more inside scoop on the specific submarket. So appreciate you guys.
Awesome. We'll take it. All right. Moises, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, thank you. Feel free to reach out to me via I'm not super active on Instagram, but I'm Correa 431 is my Instagram name. And I guess I don't know if I should share my cell phone number, but
We'll put it in the show notes.
yeah.
People listen.
Yeah.
If you want to share it, you're going to get calls.
Okay, yeah.
You may or may not want to.
Yeah, I'll hold off maybe, but there's that, and then email. Would love to set up a call, set up a coffee. Always down to meet people.
Well, are you still raising money for this deal? Or I guess, can people reach out to you if they're interested in maybe investing in one of your deals in the future?
Not for this deal specifically. This one is full, but would love to connect if you're interested in learning more about what we're doing.
All right. Chicago Fact. Who are we playing for? Who is our sponsor?
All right. So we are playing for Robbie Hansen. And Robbie, if myself or Moises gets this question right, you get a $50 gift card brought to you by today's sponsor, PMPC Architects, Prashant.
All right. Good stuff. We got an Illinois alum, so obviously went that route. I'm going to list 4 people here. 3 of them are also Illinois alum. Which one is not? And your options are Nick Offerman, Robert Ebert, Gene Hackman, Cindy Crawford. Which one of them did not graduate from the University of Illinois?
I'll say Cindy Crawford. You pick someone different, so we got a 50-50 chance.
Gene Ackman?
The answer is Cindy Crawford. Did you know that, or are you just guessing?
Well, I know she's from Sycamore, DeKalb, so I figured that was, yeah, I just didn't.
I was going to throw you off because she's down from there.
What's that?
Wouldn't you think that she would go to U of I then?
No, I guess it was too obvious, I guess. That's why I took it. So.
Yeah, but she did go to Northwestern, and I just all from Wikipedia, but she was like super, super smart.
Really?
Did not realize that. So
Brains and beauty. I love it. All right. Well, man, that's great. Robbie, you get a $50 gift card brought to you by today's sponsor, PMPC Architects, Prashant. So, Prashant, thank you for sponsoring. Robbie, thanks for coming on. Tom, thanks as always.
no, you just said Robbie again.
Oh,
Cut. Oh, we almost made a whole show.
all right. Well, Moises, thank you for coming on. Tom, thanks for coming on. Listeners, in November 8th, we're going to do a collaboration with CIC, and we're going to have a property management class here in the underground. So I'll put the link in the show notes. So November 8th, it's an all-day thing. At the end of it, you even get a property management certificate. So, all the tips I do, it's all going to be 8 hours worth of valuable housing provider tips. So check it out. Moises, thank you. Tom, thank you. Listeners, we will see you next week.
Thanks all.